So if you log into your bank account right now, or, look at the interest rate on your mortgage.
Oh, or even check your retiring portfolio.
Yeah, exactly. Or even pull up the current price of whatever crypto you might be holding, you are actually looking at the direct ripples of a single massive financial engine.
A really massive one.
Right. We are talking about a market worth over $100 trillion.
Which is just a number so big, it's kind of hard to even wrap your head around.
It really is. And, when people hear a number that large, the immediate assumption is usually, well, the stock market.
Right, or maybe like the entire real estate sector.
Exactly. But it's neither of those. It's actually the bond market. I mean, it is the absolute bedrock of the global financial system.
Yeah, it's essentially pulling the strings on almost every single dollar moving around the world today.
And yet, its actual day-to-day mechanics are rarely discussed outside of Wall Street. So, okay, let's unpack this.
Let's do it.
Our mission for this deep dive is to take the stack of source material we've gathered and really demystify the bond market. The goal here is to just strip away all that dense financial jargon.
Yeah, because it can be a lot.
It can. We want you to be able to understand the invisible machinery that is calculating the cost of money right this very second.
It's an essential mission, really, because, understanding the mechanics of that $100 trillion ecosystem is, well, it's the ultimate shortcut to being financially well-informed.
Yeah, for sure.
Once the underlying logic of the bond market clicks into place for you, reading financial news shifts from feeling like you're deciphering some foreign language to simply watching cause and effect play out in real time.
You just see the matrix, basically.
Yeah, exactly. You stop looking at stock market crashes or like inflation spikes as these random events, and you start seeing them as mathematical reactions to the bond market.
So let's start at the micro level, right down at the absolute fundamentals of borrowing. Imagine you're putting together a brilliant, just bulletproof business plan to start a new company.
Okay, I'm with you.
The passion is there, the market research is completely solid, the late-night drive to succeed is completely dialed in.
But you're broke.
Right. The only missing ingredient is the actual cash to get it off the ground. So the immediate solution is to find someone who does have the capital and ask them for a loan.
But they're not just going to hand it over out of the goodness of their heart.
Exactly. To make parting with that cash worth their while, a solid promise has to be made. You agree to pay back every single cent of the original loan, plus a predetermined little extra on top for their trouble.
And that little extra is the interest.
Yep. That dynamic, that fundamental promise between a borrower and a lender is the absolute DNA of a bond. The entity borrowing the money is the issuer, and the entity lending the money is the investor.
Right. And zooming out from that individual entrepreneur, we see governments operating on that exact identical principle.
Just scaled up, right?
Oh, scaled up to a massive degree. Governments are among the most prolific issuers of bonds on the planet. They are constantly mobilizing capital for these colossal civilization-level projects.
Like what specifically?
Well, we're talking about laying down thousands of miles of highway, funding complex healthcare systems, outfitting modern militaries. The scale of capital required to keep a modern nation functioning is just staggering.
It takes a lot of cash.
It does. And it requires constant, ongoing funding. What's fascinating here is that this borrowing acts as a massive stimulus.
Oh, right, because they spend it right back into the economy.
Exactly. If a government decides to borrow, say, a few $billions to build a new nationwide rail network, that money doesn't just vanish into a vault.
Right.
It goes directly into contracting construction firms or tech companies to build the logistics software and manufacturing plants to build the trains.
And then those companies hire thousands of workers.
Yep. Those workers take their paychecks, they buy groceries, cars, homes. That entire cycle makes citizens and businesses far more productive.
And as productivity goes up, those citizens and businesses generate more tax revenue. Because taxes, fundamentally, are the primary engine of any government's income.
They are. And the math on that tax revenue is quite revealing when we look at the sources we gathered.
Oh, yeah. The UK example?
Right. Taking the UK government as a prime example, a massive 89% of the government's total revenue comes directly from taxes.
Wow, 89%.
Yeah, only 11% comes from alternative sources. So on paper, pulling in nearly 90% of your revenue from a highly productive tax base, that sounds incredibly robust.
It sounds like a great business model. But I'm guessing there's a catch. If governments make so much in taxes, why do they need to borrow so much in the first place?
Well, the complication arises because governments almost universally spend way more capital than they collect through those taxes.
Okay, right.
That specific mathematical gap, between the tax revenue coming in and the spending going out, that is the budget deficit.
Okay, so looking at my own budget, it's like if I'm bringing in $100,000 a year, but I'm consistently spending $120,000, I have a $20,000 deficit.
Exactly.
And every single year I do that, the hole just gets deeper and deeper.
And every single year a government runs that deficit, they have to borrow to cover the difference. And that just gets added to the national debt.
Which is just the running total of all that past borrowing.
Right, the borrowing that hasn't been paid off yet.
Yeah.
And the numbers provided in our sources really put the scale of this into perspective. As of 2025, the UK national debt sits at 2.7 trillion pounds.
That's huge.
But then you look at the US. The US national debt is at a staggering $36.7 trillion.
$36.7 trillion.
Okay.
Okay, wait. That brings up a massive logistical hurdle. To cover a deficit that pushes the total debt to $36.7 trillion, a government has to find entities that actually have trillions of dollars just lying around to lend out. Where is all this extra money coming from to cover these trillions?
Well, they find that capital by going to the public, primarily through what are called treasury auctions.
Okay.
The Treasury holds these massive, highly structured sales where they issue new bonds to global investors. And, the public, in this context, refers to massive institutional players.
Right, not just a guy buying a savings bond.
No, we are talking about global banks, insurance conglomerates, and pension funds that manage the retirement savings of millions of people.
Wow.
It also includes foreign governments looking to park their national wealth somewhere secure, and, sure, regular individual investors buying bonds for their personal portfolios.
But the psychology of lending to an entity that is $36 trillion in the hole, that requires a lot of trust.
A huge amount of trust.
If a friend asked for a loan and their balance sheet showed they spend more than they make every single year, most people would politely decline. So why are they lending to the government?
Right. The willingness of the entire global financial system to line up and lend trillions to the U.S. government, it actually hinges on something entirely divorced from standard accounting.
Which is what?
It hinges on the ultimate safety factor. U.S. government bonds, specifically, are considered the safest investments on Earth.
Even with $36 trillion in debt.
Even with all that compounding debt.
Yeah.
Because the U.S. government possesses two unique tools. First, the legal power to tax its citizens to raise funds.
Right.
And second, the ultimate fallback of simply printing its own currency to ensure those bonds are paid back.
Okay, so they literally can't run out of money because they print the money.
Exactly. The prevailing logic baked into the global financial system is that if the UK, or particularly the US, were to ever actually default on its debt,
Meaning they declare bankruptcy and refuse to pay investors back?
right, if that happened, it would trigger a catastrophic cascading collapse of the entire global economy.
Oh, wow. So the assurance actually comes from mutually assured destruction.
Pretty much, yeah.
Yeah. If the U.S. defaults, the fact that your retirement portfolio lost its bond value is completely irrelevant because the entire global banking system would be offline anyway.
Yeah, that is the grim but effective reality, keeping the whole market turning. A default of that magnitude means civilization as we know it has fundamentally broken down.
We'd have bigger fish to fry?
Exactly. Investors wouldn't be checking their yield curves, they'd be bartering for basic necessities. So, because that scenario is considered virtually impossible, the debt is treated as entirely risk-free.
Okay, so we have governments mathematically guaranteed to need more money, saved only by the fact that institutional investors trust them implicitly.
Right.
But here's where it gets really interesting. To understand how that trust translates into day-to-day mechanics, we really need to trace the actual life cycle of a bond and clear up some of this financial jargon,
Good idea.
because it makes the topic feel so impenetrable. Can you break down the four main terms highlighted in our sources? Let's basically build a bond from scratch.
Sure, tracing a single bond is definitely the best way to see the machinery at work. So when a bond is first born at one of those treasury auctions, it has three permanent characteristics stamped right onto it.
Okay, what's the first one?
First is the principal. This is the initial chunk of money being invested or borrowed. So if an investor buys a $10,000 bond, $10,000 is the principal.
Got it.
The second characteristic is maturity. This is the expiration date. It is the specific timeline indicating when the loan is due and when the government absolutely must return that $10,000 principal to the investor.
This is deadline.
Yep. It could be a short-term maturity of 6 months or a long-term maturity of, say, 30 years.
Okay, so the principal is the amount, and the maturity is the clock ticking down to repayment.
Exactly. Now, the third permanent characteristic is the coupon. This is the fixed annual interest percentage the investor is guaranteed to receive while that clock ticks down.
Okay, the interest.
Right. So if that $10,000 bond has a 5% coupon, the government is legally obligated to pay the investor $500 a year, every single year, until the maturity date.
Okay.
Those three elements, principal, maturity, and coupon, they never change once the bond is issued.
Never.
Never. The complication and the fourth term from the sources is the yield.
Okay.
The yield is the actual fluctuating return an investor gets on their investment based on the current market price of the bond.
Wait, let me puzzle through that for a second. Because if the coupon is the interest, how is the yield different?
That is exactly where people get tripped up.
Because if the coupon dictates a $500 interest payment every year, it seems like the return is permanently locked at 5%.
Right. On paper, it is.
Let's try applying this to a tangible scenario.
Right.
Is it like, okay, imagine buying a VIP concert ticket.
Yeah, right.
The physical ticket is printed with a face value of $50. That $50 is permanently stamped on the paper, just like the coupon.
I like this. Keep going.
But let's say the band suddenly has a massive viral hit. The show sells out instantly, and demand just skyrockets. If someone really, really wants to go to that show, they might buy that exact same ticket from a scalper for $100.
Right. The resale market.
Yeah. The ticket still grants the exact same access to the venue. The original promise hasn't changed, but the value of the experience is suddenly different relative to the $100 they actually had to pay to get in the door.
Yes.
The return on their investment has fundamentally shifted because the purchase price changed.
I love that analogy. I mean, applying that concert ticket scenario to the bond market illustrates the exact mechanical driver of global finance. It's the seesaw effect.
The seesaw effect.
Yeah. The coupon is the printed face value on the ticket. The government promises to pay that specific $500 no matter what. But bonds are not just held in a vault until maturity.
They're traded.
They are actively traded on the open market every single day. The price of the bond is constantly changing based on supply and demand, just like that concert ticket on the resale market.
Which creates a strict mathematical inverse relationship. If the bond's price falls, the yield rises. If the price rises, the yield falls.
Exactly. Walking through the math makes that inverse relationship undeniable. Let's say you hold that $10,000 bond paying a $500 coupon.
Okay.
You decide you need cash immediately to buy a house, so you offer to sell your bond to me. But the broader financial market is currently struggling, and I refuse to pay the full $10,000 for it.
So we haggle.
Right, we negotiate, and I buy the bond from you for $8,000.
Yeah.
Now, I am holding a bond that I only paid $8,000 to acquire. But because the government's promise is legally binding to whoever holds the paper, it still pays out that fixed $500 coupon every year.
Oh, I see.
Because I paid significantly less capital to acquire that exact same $500 income stream, my actual percentage return, my yield, is mathematically much higher than the original 5%.
Right. I made $100 for a $50 concert ticket, so my yield was terrible. You paid $8,000 for $10,000 bonds, so your yield is fantastic.
The seesaw dictates everything.
Okay, but this means there have to be massive active marketplaces where these prices are being negotiated constantly. So who is deciding these prices and moving this seesaw?
Well, the sources outline two distinct arenas where this happens. You have the primary market and the secondary market.
Okay, what's the primary market?
The primary market is the source. It's the government treasury auction where brand new bonds are issued. These auctions happen on a rigid schedule, like weekly or monthly, depending on the maturity.
And the price is there.
The yield of those new bonds is determined entirely by the demand of the global banks and pension funds bidding in the room that day. Once the gavel falls and those new bonds are sold, their yield becomes the benchmark.
But then those investors immediately take those fresh bonds and turn around to sell them to someone else.
Exactly. They step right into the secondary market. This is the global bazaar, where millions of existing bonds are bought and sold every single second.
Wow.
And the prices negotiated in the secondary market are driven by this massive collective guessing game.
A guessing game about what?
Well, they're constantly guessing future market interest rates. They're guessing if the economy will speed up or slow down, and guessing if inflation will rise or fall.
So they aren't just trading paper, they are actively placing bets on macroeconomic forces.
That's exactly it. If a massive pension fund anticipates that inflation is going to spike over the next year, holding a bond with a fixed 2% coupon becomes a terrible strategy.
Right, because inflation will just completely eat that return. Their money would lose purchasing power.
Exactly. So they dump those bonds on the market. That flood of selling drives the price of the bonds down, which, following the rule of the seesaw, drives the yields up.
The price goes down, the yield goes up.
Yes, every single piece of global news, a supply chain disruption, an employment report, a shift in commodity prices, forces investors to recalculate their risk.
It's all connected.
It is. The collective yield that global investors demand in the secondary market at any given millisecond to part with their capital that actually establishes the true market interest rate. It's a real-time, mathematically pure reflection of global economic confidence.
Which brings this entire mechanism crashing back into that $36.7 trillion U.S. debt figure you mentioned earlier.
There, Doug.
Because the government is constantly interacting with these shifting market rates. And the sources point out a staggering consequence of this dynamic. I mean, the government doesn't just owe the principal, they have to service the interest on that compounding mountain of debt.
Yep. The interest is a killer.
Our sources say the interest payments alone on the U.S. national debt are currently running at roughly $3 billion per day.
$3 billion a day, merely to tread water, without retiring any of the underlying principal.
That is just hard to comprehend.
It's wild. And if we connect this to the bigger picture, that figure exposes a profound structural vulnerability in the system. It's known as rolling over the debt.
Rolling over?
Yeah. See, a massive portion of government debt is not locked into those safe 30-year timeframes. A lot of it is issued in short-term treasury bills that mature in incredibly tight windows. We're talking 6 months, 12 months, or 18 months.
Okay.
When those short-term bonds reach maturity, the government is legally obligated to hand the investors their principal back.
But because we already established they're running a massive budget deficit, they don't have the cash in the vault to actually pay them.
Right. So to satisfy the old investors, the government is forced to immediately return to the primary market and issue new debt.
Oh, wow.
They borrow new money from new investors just to pay off the old money. This is the process of rolling over.
That sounds like a trap.
It is. And the trap snaps shut when market interest rates change between those cycles. If inflation has spiked and the secondary market has driven yields up, the government is now forced to borrow that new money at a much higher, far more expensive interest rate.
Oh, I see the gravity of this now. The
Yeah.
compounding effect of that is just severe. I mean, a country's gross domestic product, the total wealth it generates, is finite.
Exactly.
If a country is forced to roll over trillions of dollars of short-term debt at 5% interest instead of 2%, that $3 billion a day figure skyrockets.
It balloons out of control.
And as more of the national wealth is sucked into the black hole of servicing this compounding debt burden, there is less money available for public services.
Right.
It means billions less for maintaining crumbling infrastructure, less for healthcare, less for social safety nets and national defense. The economic pie isn't getting any bigger, but the slice devoted entirely to paying interest is just devouring the rest of the budget.
Unless the government decides to just borrow even more money to cover that widening gap, which just accelerates the compounding effect for the next rollover cycle.
Right.
It's a mathematical treadmill that constantly increases in speed.
Okay, so what does this all mean? I mean, having mapped out how this machinery squeezes national budgets, let's pivot to the listener's personal portfolio.
Good idea. Let's talk about stocks.
Yeah. How does this bond market chaos affect the stock market? Because the bond market doesn't exist in a vacuum, right?
Not at all. The connection between the two markets really comes down to how institutional capital evaluates safety versus risk.
Okay.
Government bonds, as we establish, are backed by the power of taxation and currency creation. They are a virtual certainty, a guaranteed return unless civilization ends.
Right.
Stocks represent the complete opposite end of the spectrum.
Hmm.
Buying a stock means purchasing a tiny fractional ownership stake in a corporation.
And companies fail all the time.
Exactly. If a company experiences a leadership scandal, gets crushed by a new competitor, or just mismanages its cash flow, its stock price plummets.
Your stock plummets with it.
Right. There is a very real possibility of losing your initial investment. So if an investor has a choice between a perfectly safe 5% bond and a risky stock of the exact same value, the bond is the wiser choice.
Right, because there's a tangible risk of total loss with a stock. So an investor needs a compelling mathematical reason to choose it over a guaranteed bond.
Exactly.
If a government bond offers a completely secure return, they would demand a significantly higher potential payout from a stock to justify taking on the risk of losing their shirt.
That exact calculation is codified in finance as the equity risk premium, or ERP.
Equity risk premium.
Yes, because government bonds are so secure, their interest rate acts as the baseline for the entire financial system.
Mm.
It is officially known as the risk-free rate. The equity risk premium is the necessary gap between that safe risk-free rate and the higher expected return of the stock market. It's the extra percentage points investors demand as compensation for enduring the volatility of equities.
So just to clarify this, when bond yields rise, that equity risk premium shrinks, meaning investors will basically dump their stocks because they aren't being rewarded enough for the risk, and they flock to bonds instead.
You nailed it. That is exactly how bonds drive stock market sell-offs. The capital simply flows down the path of least mathematical resistance. Rising bond yields act as a massive gravitational pull, just draining capital out of the stock market.
That makes perfect sense.
And, this precise dynamic of evaluating risk against a safe baseline exists within the bond market itself, too. Specifically when we look at corporate bonds.
Oh, right. Companies issue bonds too.
They do. Just as governments issue debt to build highways, corporations issue bonds to fund research and development or build new factories.
But companies can go bankrupt.
Exactly. They lack the two safety nets of the government. They can't levy taxes, and they can't legally print money, making their bonds much riskier.
Right.
Because of that inherent risk, corporate bonds must offer higher yields than government bonds to attract capital. And the mathematical gap between the low yield of a safe government bond and the higher yield of a risky corporate bond is called the high yield spread.
High yield spread.
Yep. Under normal economic conditions, this spread remains relatively stable.
But when market fear rises.
Exactly. If rumors of a severe recession start circulating, investors demand much higher interest from corporate bonds to compensate for the risk of bankruptcy.
They need a bigger reward for taking on that fear.
Right. And watching that high-yield spread widen when corporate yields skyrocket while investors simultaneously flock to the safety of government bonds, it's a massive warning sign of market trouble. It's a huge red light on the economic dashboard.
Pulling all these mechanisms together, it really reveals the true nature of this $100 trillion ecosystem.
Yeah.
I mean, synthesizing everything from our sources, the most crucial takeaway is that the bond market is not just a mirror reflecting the state of the economy.
No, it's not.
It actively shapes it. When interest rates go up in the bond market, it acts as a massive brake, slowing down the entire global economy. It makes borrowing prohibitively expensive for businesses trying to expand, it drives up mortgage rates, and it suffocates the stock market.
It really does. And I have to commend you, the listener, for making it through such a complex topic today. Navigating the sheer scale of this system is challenging. But you now understand the true engine of global finance better than most?
You really do. The invisible machinery is finally visible. But the mathematics of what we've unpacked today leaves one massive lingering question based on the source material's logic for you to chew on.
Oh, definitely.
We examine the reality of governments trapped in a cycle of constantly rolling over short-term debt at potentially higher interest rates. If governments are stuck in this cycle, at what specific mathematical point will the daily interest payments simply eclipse all other government spending combined?
It's a scary thought.
And when that inevitable moment arrives, what radical, unprecedented changes will that force upon the everyday taxpayer?
It is truly the defining financial question of our era, and the bond market is actively calculating the countdown.
A mechanism to keep a very close eye on the next time a politician promises a massive new spending initiative. Well, thank you for joining us as we mapped out the true engine of the global economy. We will see you on the next deep dive. Take care.